your money sits idle. Right now, thousands of dollars languish in savings accounts, earning maybe 2 or 3% annually if you're lucky. Meanwhile, inflation chips away at purchasing power. Each year that passes means less buying capability for retirement. Why does this happen? Not because you lack intelligence. Not because you can't grasp financial concepts. The culprit is simpler: too many choices. Researchers discovered something counterintuitive decades ago. More options don't improve decisions. They paralyze them. Psychologist Barry Schwartz documented this extensively. His studies revealed a troubling pattern. When people face abundant choices, they freeze. Consumer researcher Sheena Iyengar ran a famous experiment with jam. She set up tasting booths at an upscale grocery store. One booth displayed 24 varieties. Another showed just 6. The large display attracted more browsers. 40% of shoppers stopped to sample, but only 3% made purchases. The small display, fewer browsers initially, only 40% stopped. Yet purchases jumped to 30%. That's a 10-fold increase in actual buying decisions. Think about what this means for your financial life. Today's investors confront more than 700,000 managed investment products worldwide. 20 years ago, that number was 30,000. By next decade, projections suggest it'll reach 1 million options. You face mutual funds, exchange-traded funds, stocks, bonds, real estate investment trusts, commodities, cryptocurrencies, and countless variations within each category. Every option carries different expense ratios, performance histories, risk profiles, and tax implications. Decision fatigue sets in fast. Research published in behavioral finance journals shows this abundance creates 3 destructive outcomes. First, inertia. People simply do nothing. Second, naive diversification. Investors spread money across everything without strategy, hoping something works. Third, attention-grabbing bias. Flashy investments capture focus while boring, effective options get ignored. Analysis paralysis isn't laziness, it's cognitive overload. Here's what that paralysis costs you. Imagine you keep $20,000 in a savings account for 20 years. With average inflation at roughly 2.2% annually, your purchasing power erodes relentlessly. Even if the account earns 2% interest, you're losing ground. Now consider the alternative. That same $20,000 invested in a basic market index over those 20 years would have grown substantially. Historical S&P 500 returns average around 10% annually since inception. Accounting for inflation and typical market fluctuations, real returns hover near 7%. The difference? Over $40,000 in opportunity cost. That's not theoretical. Researchers tracking investor behavior documented this pattern repeatedly. Money sits dormant not because people choose safety consciously. It sits there because making the investment decision feels overwhelming. You've experienced this yourself, haven't you? You decide to start investing. You research options. You read articles comparing fund performances. You watch videos explaining different strategies. You check forums where people debate optimal allocations. The more you learn, the less confident you feel. Each expert contradicts the previous one. This analyst recommends growth stocks. That one suggests value investing. A third advocates international diversification. Another warns against foreign markets entirely. Research should clarify. Instead, it multiplies questions. Should you invest in large cap or small cap funds? Active or passive management? Growth or value orientation? Domestic or international? Target date or balanced portfolios? What expense ratio counts as reasonable? How much diversification proves sufficient? These aren't trivial questions. But here's the truth most financial content won't tell you. Obsessing over these details costs you more than making a merely good choice and moving forward. Sitting on the sidelines represents your biggest risk. Financial planners surveyed investors about their greatest regrets. Surprisingly, most didn't regret bad investments. They regretted inaction. Years spent researching perfect entry points. Months comparing minutely different fund options. decades procrastinating while markets moved upward. One investor interviewed for a behavioral finance study captured it perfectly. "I spent 3 years trying to find the absolute best investment strategy. During those 3 years, the market gained 40%. My perfect plan would have needed to outperform the basic index by 13% annually just to catch up. The opportunity cost of waiting exceeds the risk of choosing imperfectly." If you're in your 50s or 60s, this paralysis carries higher stakes. You possess less time to recover from inaction. Every year matters exponentially more. Compound growth needs time to work its magic. At 30, you have decades ahead. At 55, you have perhaps 10 to 15 years before retirement. Consider this scenario. You're 55 with $50,000 sitting in cash. You intend to invest but keep researching optimal strategies. 5 years pass. You finally invest at 60. During those 5 years, assuming 7% average returns, you miss $20,000 in growth. That lost growth would have generated another $15,000 or more by retirement at 70. Total opportunity cost, roughly $35,000. That's not speculation. Those numbers reflect historical market behavior. Financial services companies don't help this situation. They profit from complexity. More products mean more fees. Sophisticated-sounding strategies justify higher management costs. Constant innovation keeps you feeling outdated, dependent on expert guidance. Consider how many investment categories have proliferated recently: smart beta funds, alternative beta strategies, long-short equity approaches, market-neutral portfolios, tactical asset allocation models, risk parity frameworks. Each sounds important. Each promises something traditional approaches supposedly lack. Yet research comparing complex strategies against simple approaches reveals uncomfortable truths. After fees, most sophisticated strategies underperform basic index investing. Studies by financial economists consistently demonstrate this pattern across decades. The investment industry creates problems, then sells you solutions to problems that needn't exist. What if you could eliminate 99% of these decisions? One investment type does exactly that. Target date funds. These funds operate on a straightforward principle. You select a year corresponding roughly to your planned retirement. The fund managers handle everything else. They diversify across stocks and bonds. They rebalance periodically. They gradually shift toward conservative allocations as your target date approaches. You make one choice. Then you automate contributions. That's the entire strategy. Money expert recommendations consistently highlight target date funds for exactly this reason. They work. Not because they're magical, because they remove the decision-making burden that paralyzes investors. Target date funds follow what's called a glide path. Imagine an airplane descending for landing. It starts high with aggressive growth-oriented investments when retirement remains distant. Gradually, it descends toward conservative, income-focused holdings as retirement nears. A 2050 fund for someone retiring around that year might currently hold 90% stocks, 10% bonds. That allocation automatically shifts over time. By 2045, it might be 70% stocks, 30% bonds. By 2050, perhaps 50-50. After retirement, it continues adjusting toward capital preservation. You don't manage this. Professional portfolio managers do. These funds typically contain dozens or hundreds of underlying investments. You get instant diversification across domestic stocks, international stocks, various bond types, and sometimes alternative assets, all bundled into one ticker symbol. Target date funds have grown dramatically popular for good reason. By end of 2023, investors had placed more than $3.5 trillion into these vehicles. That figure has doubled in just 8 years. Why? Because they eliminate analysis paralysis while delivering solid results. Studies examining target date fund performance show they provide returns comparable to professionally managed portfolios. After accounting for the time and stress saved, they often prove superior for typical investors. Most workplace retirement plans now use target date funds as default options. When employers automatically enroll workers into retirement accounts, they usually select target date funds. This choice has increased participation rates significantly. Behavioral research explains why. People who must actively choose among 20 investment options often choose nothing. Those automatically enrolled into one simple option tend to stay invested and maintain contributions. Fees matter enormously over time. A fund charging 1% annually versus one charging 0.1% creates dramatic differences across decades. That 0.9% gap, compounded over 30 years, can cost you 30% or more of your final portfolio value. Many target date funds charge low fees. Major providers offer options below 0.15%. That's because they invest in low-cost index funds rather than expensive, actively managed alternatives. Not all target date funds equal each other, though. Some charge above 1%. Those exist to profit fund companies, not serve investors. Always check expense ratios before selecting a fund. Financial advisors sometimes criticize target date funds. They claim these funds are too conservative, or too aggressive, or insufficiently customized, or lacking in sophistication. Consider the source of such criticism. Many advisors earn fees by managing custom portfolios. Target date funds eliminate the need for their services. Their objections often reflect self-interest rather than investor welfare. Some criticism holds validity. Target date funds assume average risk tolerance. If you're unusually conservative or aggressive for your age, the standard glide path might not suit you perfectly. But here's the crucial question: does seeking that perfect customization justify years of inaction? Does the theoretical benefit of optimization outweigh the concrete cost of delay? For most investors over 50, the answer is clearly no. A wealth accumulation principle applies here. Perfect plans executed never beat good plans executed immediately. The compounding effect of time in the market dwarfs the optimization benefit of slightly better asset allocation. Research comparing investor outcomes consistently demonstrates this truth. Investors who agonize over optimal strategies typically accumulate less wealth than those who choose reasonable strategies quickly and stick with them consistently. This doesn't mean abandon all planning. It means distinguish between essential decisions and marginal optimizations. Choosing to invest versus not investing, essential. Selecting 85% stocks versus 90% stocks, marginal. Finding the lowest fee provider, essential. Debating which low-fee provider has fractionally better holdings, marginal. If you've been paralyzed by investment choices, here's your path forward. Step 1. Decide where you'll open an account. Choose a major provider like Vanguard, Fidelity, or Schwab. These companies offer low-cost target date funds and maintain strong reputations. Pick one and move on. They're all adequate. Step 2. Determine your approximate retirement year. You need not be precise. If you're 55 and plan to retire around 70, select a fund targeting 2040. Close enough works fine. Step 3. Look at that provider's target date funds. Find the one matching your retirement decade. Check its expense ratio. If it's below 0.2%, it's acceptable. Below 0.1% is excellent. Step 4. Open the account. This takes perhaps 30 minutes online. You'll need basic information like social security number and bank account details. Step 5. Set up automatic monthly contributions, whatever amount you can sustain. Even $200 monthly compounds significantly over years. Step 6. Stop researching. Close the browser tabs. Unsubscribe from financial newsletters. Check your account perhaps quarterly. Resist the temptation to tinker. That's the complete system. Beyond financial returns, this approach provides peace of mind. You eliminate the nagging feeling that you should be doing something about your investments. The decision is made. The system runs automatically. Your mental bandwidth frees up for other concerns. Behavioral finance research shows decision fatigue affects all areas of life. When you spend mental energy agonizing over investment choices, you have less capacity for other important decisions, work problems, family matters, health choices. Automation returns that mental capacity. Research on automatic enrollment in retirement plans reveals an interesting pattern. People who must actively manage their investments check them frequently. They make changes based on short-term market movements. They experience stress during downturns. People in automated target date funds check their accounts far less frequently. They make fewer changes. They stay invested through market volatility. Paradoxically, they experience better returns precisely because they pay less attention. Target date funds aren't right for everyone. If you genuinely enjoy researching investments, possess substantial financial knowledge, and can dedicate ongoing time to portfolio management, you might prefer a custom approach. If you have complex financial situations, multiple income sources in retirement, significant real estate holdings, business interests, you might benefit from professional financial planning that coordinates all elements. If you have already accumulated substantial wealth and need tax optimization, strategies like asset location across account types, a more sophisticated approach might prove worthwhile. But for most people approaching or in retirement with straightforward financial situations, target date funds provide an elegant solution. They deliver diversification, professional management, and automatic rebalancing at low cost with minimal effort. Let's discuss something most investment advice glosses over. Portfolio rebalancing requires discipline most people lack. Say you decide on 70% stocks, 30% bonds. After a strong year for stocks, you might be at 80% stocks, 20% bonds. Proper management requires selling some stocks which just performed well to buy more bonds which underperformed. This feels wrong. It contradicts natural instincts. Research shows most investors fail to rebalance consistently. They drift toward increasingly aggressive allocations during bull markets, then panic during corrections. Target date funds handle this automatically. Managers rebalance according to predefined schedules. You never face the temptation to chase performance or avoid discipline. This automatic rebalancing has saved investors countless dollars during market cycles. Studies tracking behavior during the 2008 financial crisis showed target date fund investors were far less likely to panic sell compared to self-directed investors. Another consideration often overlooked involves tax efficiency. If you're investing in tax-advantaged accounts like IRAs or 401ks, target date funds work excellently. Inside these accounts, the fund's internal rebalancing generates no tax consequences for you. If you're investing in taxable accounts, tax efficiency matters more. Some target date funds handle this well. Others generate significant taxable distributions. Check the fund's tax cost ratio before investing taxable money. Many providers now offer specific target date funds designed for taxable accounts. These use tax-efficient underlying holdings and minimize distributions. Worth investigating if you're investing outside retirement accounts. Let's address return expectations honestly. Target date funds won't make you rich quickly. They won't beat the market dramatically. They won't provide excitement. They will, however, deliver market rate returns with appropriate risk management. Over 20 to 30 years, market rate returns compound into substantial wealth. Historical stock market returns average around 10% annually. Bond returns average 5 to 6%. A diversified portfolio targeting retirement typically generates 7 to 8% long-term. That might sound unimpressive compared to stories about cryptocurrency gains or hot stock picks. But consistency beats excitement in wealth building. Someone who invests $500 monthly for 20 years at 7% average return accumulates roughly $260,000. At 8%, it grows to $295,000. These figures assume no raises, no windfalls, just steady contributions. Most people never accumulate this much precisely because they chase higher returns instead of accepting good enough returns consistently. Avoid comparing your target date fund performance to other investments. This comparison triggers the very paralysis you're trying to escape. Someone will always have a better performing investment. Some stock will always outperform your diversified fund. Some strategy will always appear superior in retrospect. Remember, the goal isn't beating the market. The goal is building sufficient wealth for retirement. Target date funds accomplish this reliably for millions of investors. Financial media profits from making you feel inadequate about investment performance. They highlight extraordinary gains while ignoring the far more common losses. They showcase complex strategies while dismissing simple approaches. Resist this manipulation. Your target date fund moves you toward your retirement goal. That's success. Consider the alternative to action. $30,000 sitting in savings for 15 years at 2% grows to roughly $40,000. Inflation at 2.5% annually means your purchasing power actually declined. You can buy less with $40,000 in 15 years than you could with $30,000 today. That same $30,000 in a target date fund averaging 7% becomes approximately $83,000. Even after inflation, your purchasing power more than doubled. The opportunity cost of inaction, $43,000 in this scenario. That's not a small amount for someone approaching retirement. Multiply this across all the money sitting idle. Across all the years you've delayed, the numbers become staggering. Investment success doesn't require sophistication. It requires three things: starting, contributing consistently, and staying invested long-term. Target date funds enable all three by removing complexity. You don't need to become a financial expert. You don't need to track economic indicators. You don't need to understand monetary policy or analyze corporate earnings. You simply need to choose a fund, set up automatic contributions, and let time work. This approach won't impress people at cocktail parties. You can't brag about clever investment moves. You won't have exciting stories about market timing. But in 15 years, you'll have financial security. That's worth far more than impressive, sounding strategies that never get implemented. Your money sits somewhere right now. It's either growing or stagnating. It's either working toward your future or slowly losing value to inflation. The longer you wait to decide, the more that opportunity cost accumulates. Analysis paralysis isn't a character flaw. It's a predictable response to overwhelming choices, but recognizing it doesn't solve it. Action solves it. Choose a provider. Select a target date fund. Set up automatic contributions. These 3 steps take perhaps 2 hours total. Then you're done. The system runs itself. Everything else is refinement. Refinement can wait. Starting cannot. Your future self will thank you not for finding the perfect investment strategy, but for taking action when it mattered most. The best investment approach is the one you actually implement. The second best time to start was years ago. The best time to start is today. Stop researching. Start investing. Let the simplicity of a single choice replace the paralysis of endless options. Your retirement depends not on optimal decisions, but on timely ones.